Welcome everyone to tonight's real estate presentation on the San Diego real estate market combined with an economic update. This will be our last presentation of 2024. So we'll take a look at where the real estate market is today and where it is likely to go into 2025. Additionally, because the number one thing driving the real estate market today is interest rates, we're going to do a little bit of a deep dive to discuss interest rates, where they're at, and more importantly, why interest rates are where they're at and where they will likely head going into the future. So with that, let's get into it. We've got a lot of new information, a lot of new slides, a lot of new data that we'll share with you today. And I hope to see you all again next year too. We'll do another update in January. Quick background on myself. My name is Patrick Capel. I am the team leader of Capel Realty Group. I have a little over 15 years of experience in the San Diego real estate market. I started buying real estate 15 years ago, plus or minus, in my 20s. I'm in my 40s now. And over that time, I purchased 8 properties, about one every 2 or 3 years, and learned a lot about real estate, owning it as a house, also investing in it. During that time, I was serving in the Navy. I ended up serving 24 years in the Navy between active duty and the reserves. And during my time in the reserves, I built the team I have today. The Capel Realty Group, which is ranked as one of the top teams in the nation, certainly in San Diego. And we're a team of professionals that help folks buy and sell real estate, both as a home and also as investment. I might be biased, but I truly believe the real estate agents within our team, Capel Realty Group, are some of the best in the business that you'll find. With that said, when you work with the best, you end up being high demand. Our team has helped San Diegans buy and sell over $500 million in real estate in just the last 5 years. You see in the center there, education. I am a huge proponent of education, not just receiving it, but also giving it. My mom and dad were both high school teachers, maybe that's why, but I started my education at the Naval Academy where I got a bachelor's of science, followed by an MBA at UCLA, and I followed that master's degree with a second one, a master's of science in real estate. So I hope that you can relate a little bit as I teach. And hopefully I'm a good educator for you to teach you a little bit about real estate, where it's at, how it works, and not just real estate, but also interest rates and our economy and demographics and how it all plays together. You see the awards there on the right. It goes without saying our team has been ranked nationally every year for the last 5 years as one of the top 1% of real estate teams in the United States. And we currently are one of the top teams here in San Diego. In fact, there it is. I do not stand alone. I stand with a big team together, and we work together collectively and collaboratively to help our clients. Within 5 years, in fact, less than 5 years, we became San Diego's #1 team at the #1 brokerage based on the number of transactions per year. We earned that in 2023, and it looks like we probably will again this year. So trust me, when you're working with my team, when you're listening to the information and data that I'm putting out there, it comes from not just an educational background, but a real boots on the ground in the trenches. We know what's going on. We see what's happening in the San Diego real estate market. And last little tidbit of housekeeping before we get into it. If you want to reach out to me after tonight's presentation with any questions, any information, or if you'd like to work with my team, the best way is my email. You see it in the top right, patrick.capel@compass.com. Additionally, we have literally dozens of other educational webinars that have been uploaded to our YouTube channel. You can find that YouTube channel simply by scanning the QR code on your screen, or just go to YouTube, type in Capel Realty Group, and you'll find everything from market updates like we're going over today, to House Hacking 101, how to live in your house for free in San Diego, how to gain access to your down payment. Did you know you can access over $100,000 tax-free given to you by the government to help you buy your first home? Got a webinar on that, how to invest in 2 to 4 unit properties. You name it, we probably got it in the YouTube channel. And if you've got spare time over the holiday, maybe you might want to watch a few of those. So with that, as I typed in already, if you have any questions, you can type them into the Q&A, type them into the chat. I will answer any and all questions at the end of today's presentation. Now and then I like to start with this slide because it's so true. Most real estate agents know what's happening. Home prices are high, interest rates are pretty high, but coming down a bit. The next thing is good agents. Good agents understand what's happening. Interest rates aren't just high, they're actually going down a little bit. Home prices aren't just high, they've gone up a lot throughout the year, but now in the last couple of months, they're going down a bit. Why is that? And that's great agents. Great agents can explain what's happening, the why. My goal tonight is to explain what's happening and the why behind it. I do that in a very fancy way. A lot of people say they don't have a real estate crystal ball. I disagree. We do have a crystal ball, and it's called data and analytics. If you look at data and you dig into what's going on in the market, you understand not only where you are, not only where you came from, but also where you are going. And what we'll look at today with the economic and real estate update is all three of those. Where have we been? Where are we at? And where are we going with San Diego real estate? I sometimes too like to cut to the chase because I know throughout my 60-minute presentations, some people might be thinking, well, Patrick, thank you for all the data, but I just want to know what's going to happen. So let's cut to the chase now and then backfill it with a bunch of information and data to show you the why. Now, the 2025 housing forecast has already come out. I'm going to show you the California Association of Realtors forecast. And no, this is not a forecast made by real estate agents. This is a forecast made by economists with PhDs in economics and real estate that work for the California Association of Realtors. So what are the economists telling us for our fine state, the Golden State? They're looking at home sales to increase. The first two line, SFH, that's single family homes. That's the number of homes in hundreds of thousands that have sold every single year going back to 2018, and the projection, the forecast for 2025. And as you can see, next year, it's anticipated that there will be 10.5% more home sales in California than there were in this year in 2024. But the all important question, what's going to happen to pricing? The median price throughout the state of California is expected to be 909,000 over the next 12 months by the end of next year. That represents a 4.6% increase to home prices in the state of California. Later in tonight's presentation, I'm going to show you a few other organizations' forecasts for the nation, the national home prices. We can see here the California home prices expected to go up about 4.6. I can tell you right now, most economists are predicting national home prices to go up 3 to 4%. Also, keep in mind, real estate is very local. It really doesn't matter what happens on the East Coast, the Midwest, the South, the Northwest. It doesn't even really matter what happens in the entire state of California if you're focused on buying or selling a San Diego home. What is important to you in that case is what's going to happen to San Diego real estate prices. Well, San Diego usually appreciates at about 1.5 to 2 times more than the rest of the nation, with the rest of the nation anticipated to appreciate about 3 to 4%, California at 4.6%. I anticipate that San Diego home prices will likely appreciate 8% plus or minus 2. You got to have that little buffer room right there because no one can ever say it's going to do this for sure. But I can say this. I would be surprised if San Diego doesn't appreciate at least 6%. And I'd be surprised if it appreciated more than 10%. And that's based on me looking at data trends here locally in our San Diego market, going back a decade, coupled with an MBA that focuses in finance and economics and a master's degree in real estate, and having a team that has real boots on the ground to see what's happening in our market. So you can anticipate next year, San Diego appreciation of our real estate values on average, 8% plus or minus 2. But with that said, let's get into the nitty gritty data of what's really gone on over the last year and the last 10 plus years. In fact, that 8% number might seem a little bit high to you. But look at this, folks. If you go back to 2012, over the last 12 years, 2012 to 2024, the average annual rate of appreciation has been about 8.6%. If you go back the last 10 years, the last decade in San Diego, our average appreciation has been 8%, almost right on the money, 8%. So 8% appreciation year over year in San Diego is kind of our norm. So what am I saying for next year? I'm saying next year is going to be a little bit of the norm. I think it could be a little bit higher, 9, 10%, because interest rates could go down faster than anticipated. But I think we'll have a slow drop in interest rates over the next year. We'll see. Now, as you look at the chart in front of you, let me draw your attention to the bottom half of your screen where you see the blue line and the red line. The blue line is simply the price of single family homes. The red line is the price of attached homes, so condos and townhomes. Now, you might notice that the blue line's gone down a little bit in the last couple of months. So has the red line, actually. That's not surprising. That's to be expected. It doesn't mean doesn't mean the housing market's going down. Doesn't mean home prices are crashes. They're not. Home prices always go down October through January. They always do. If you go back again to 2012, you can see the chart. Well, it has an upward trend line. About every 12 months, there's a little dip, and then it picks up again, and then a dip, and then it picks up again, and then a dip. That's the seasonality of the real estate market. Seasonality, real estate values typically peak around May, June, July, and then they start to go down. August, September, October, November, December, January, prices go down, and then they start going up again February through July. And usually the increase that we see February through July is more than the decrease that we see in the fall and the winter, creating a long-term trend line going up. As a home buyer or as a home seller, how can you use that data fact to your advantage? If you're buying real estate, buy it in the fall and the winter. You will pay less money if you buy real estate in the fall and the winter. If you're a seller, do not sell in the fall and the winter unless you really have to. You'll sell for less money if you sell in the fall and winter, and you will sell for more money if you sell in the spring and the summer. And you can see that over the last 12 months. We see last December 2023, prices were $945. Then they gradually went up all the way through June. And then there we get to the end of the summer, July, prices start going down again. That's just seasonality, doesn't mean there's a crash. The other important data point to look at is inventory of homes for sale. I shared this slide because I'd really like to impress upon folks that we are at some historical low levels of inventory. There's just not enough housing out there in San Diego, in California, or in the United States. And that inventory drop didn't happen because of COVID or after COVID. That inventory drop was already in the making in 2019. As you can see, in 2019, we had a huge drop in inventory, and that inventory drop just became exacerbated throughout the COVID pandemic and has not gone back up. So you might be wondering, why is that? There's really two main reasons. One, this is a short-term reason that will get corrected as interest rates go down. And that is during COVID, interest rates were in the 2s and the 3s. So anyone who bought a home and everyone who already owned a home was able to refinance their mortgage into an interest rate in the 2s, the 3s, at the highest, the 4s. And right now, homeowners sitting on a 3 or a 4% mortgage, they don't want to sell their home and buy a new home just to go get a 6.5 or 7% mortgage. So they're just sitting tight in their homes until rates go down. Even if they've had maybe 2 more babies in the last 5 years, they don't want to give up that 3% interest rate. Once rates get into the 5s, we will likely start to see some of that inventory loosen up and those homeowners be willing to sell their home and get rid of their 3 or 4% mortgage to get a mortgage in the 5s. But you must keep in mind that's a net zero, because for every home seller that sells their home, they also need to buy a new home. So that does not add inventory to our market. Which gets me to really the big long-term reason we have such low inventory. It comes down to two things. We had something called the Great Recession back in 2008, 2009, where we overbuilt homes. We created too easy lending standards. Anyone could get like 3 or 4 loans. And we had a housing crash because there was way more supply than there was demand. So over the next 10 years, from 2009 to 2019, Home builders and developers did not build enough homes, not at all. And the decade of lack of building intersected with the largest generation in American history, millennials, followed by Gen Z, hitting first-time homebuyer age, early 30s. So around 2019, 2020, our millennial generation hit their late 20s, early 30s, and that is traditionally first-time homebuyer age, and it intersected with a decade of not building homes. And when you intersect the decade of not building homes, along with the biggest generation Americans hitting first-time homebuyer age, you just have a drop off a cliff of not enough inventory for all these folks, and that which does exist gets gobbled up pretty quickly. So do I anticipate inventory to pick up a lot, even when interest rates go down? It will pick up a little, but not a lot, because the homes will get gobbled up by the people selling homes and the millennial and Gen Z aging in to first-time homebuyer age. The other chart I want to share with you is percent of original list price received. So what is this? Let's say a home is it's listed for $1 million and it sells for 999,000, 990,000. It sold 1% below list price. So list to sales price ratio is, or percent of original list price received would be 99%. And as you can see, throughout 2024, and really throughout the history of San Diego, home prices typically sell pretty close to their list price. There were a few years in 2021 and 22 where homes were even selling above list price. Right now, here we just came out in November, most homes are selling about 97.8%, about 98% of list price. Now, this doesn't mean that every home is selling below list price. Some homes are selling 5%, 10% below list price. Some homes are selling 5% above list price. I always tell my clients, and I want to make this very clear to all of you, list price has nothing to do with the value of a property. And that might seem kind of weird because as American consumers, we're so used to like going to the store and paying whatever the sticker price is. If something's $10 on the shelf, you pay $10 plus a little tax. But in real estate, even when people don't advertise real estate as an auction platform, it is an auction platform. 100% of properties sold are an auction platform. And what I mean by that is things don't have to sell at list price. They often sell above list price and sometimes below. Now, intelligent real estate agents will usually list a property right below what it's worth. Why would they do that? It's so that they can get multiple offers and create a bidding war to sell it for its market value, if not more. Now, I hate to put it this way, but folks who don't understand marketing, some agents, some sellers will list a property for more than it's worth. And then the property will sit and sit and sit. In a few weeks, a few months later, price reduction after price reduction, and it ends up selling for less than it's worth. So getting a property below list price isn't necessarily a good deal. Maybe a home is worth $950,000 and it's listed for $1 million and you buy it for $975,000. It doesn't mean you save $25,000 by buying it for less than list price. It might actually mean you paid more than you should have because the value of the home was $950,000. So how do you know the value of a home? You probably don't. If you don't work in real estate, you probably don't know the value of a home. You have to be someone who works in it, sleeps in it, breathes it, eats it, it's got to be running through your veins to understand the real value of properties out there. It's something you learn over time. You look at comparable sales. You've walked into hundreds of homes to get an idea. I push this slide out there because you're going to see times where list price is above. You're going to see times when the sales price is below list price. But really go off the guidance of someone you trust to know if you're overpaying, underpaying, or getting a fair deal. And I always like to say this, a fair deal is buying a property or a good deal. A good deal in San Diego is buying a property at whatever price, fair market value, and holding it for 5 to 10 years. I've got clients who wish they bought 5 years ago, but they didn't because they were waiting for a unicorn. Unicorns don't exist. Buy, hold, you'll never regret that in San Diego. So what's going on with our prices? What's going on with supply? What's going on in demand? You saw that we don't have enough supply. I'll show you some future slides that show you the demand. But at the end of the day, the value of things comes down to one easy, simple equation. Supply and demand. If you have less supply than you have demand, prices will go up. And right now, and for the last 5 or 10 years, we have found ourselves in a situation like this where there is not enough supply relative to demand. And mark my words, I'm 43. I'll probably live another 50 years. I do not think in my 50 years of life I have left that we will ever have enough supply in San Diego for the demand that our city faces because of the economic growth, because of the biotech growth, because we have one of the nicest climates in the world, and because we have government regulations and restrictions that prevent us from building. And San Diego is very special in the sense that we have nowhere else to build out to because to the west is the Pacific Ocean, to the north is Camp Pendleton, a Marine Corps base, to the east is the Cleveland National Forest, and you can't build a national forest. Into the south is another country called Mexico. We are as landlocked as Hawaii is when it comes to the ability to build. And for all these reasons, I do not believe in the next 50 years we will have enough supply to meet demand. Is that good or is that bad? It depends what way you look at it. But if you own real estate, and the more you own, that means you're going to become pretty wealthy over time because the prices are going to outpace the prices of real estate in other markets and in other states. Bottom line up front, this is one I always have up. There's not a real estate crash on the horizon, not at all. Anyone who says there's a real estate crash on the horizon, ask them where their degree is in economics and real estate, and I bet you they don't have one. There's not enough real estate supply. That is why the only way you can have a crash with any product, including real estate, is to have more supply than there is demand. Over the long term, as mentioned, prices will keep going up. And also, if you're a renter, trust me, mark my word, rent will also keep going up. Now is a good time to buy real estate. Why is now a good time to buy real estate? It's because interest rates are relatively high. They're in the mid sixes. So a lot of folks are waiting on the sidelines for rates to come down further. Maybe they're waiting for the spring and the summer. The best time to buy is when you don't face a lot of competition. You don't face a lot of competition right now because it's December, it's January, and rates are in the mid sixes. And we'll get into a strategy that you can employ at the end of the presentation here. But let's talk interest rates for a moment because this has really been on the news for the last couple of years. And this is really what's going to drive the demand side of the equation to go up even more. Now, over the next 2 to 3 years, rates will likely keep on coming down slowly but surely. However, you're likely not going to see a massive drop in rates. And as rates go down, you'll see home buyers start to trickle back into the market, more and more demand, more and more demand. But what you will not see is a lot of supply coming to the market because we just haven't built enough supply. Now, what you're seeing in front of you is the last couple of years of mortgage interest rates. Where have they been? Where are they going? Rates were on a downward trajectory ever since May. You can see we kind of peaked out for the year in May at about 7.2, 7.3 interest rates. We peaked out in 2023 at almost 8%. Well, since May, rates have been going down and down. The Federal Reserve has been lowering rates. And then all of a sudden, something happened in October. And then in November, and rates started going up more and more and more. Why is that? Number one, we had a really good jobs report in October. Good news causes interest rates to go up, and I'll talk about that in a minute. Also, the presidential election happened, and the policies coming in with the new administration could potentially cause more inflation, which would cause interest rates to have to stay higher longer. Well, why is that? What controls interest rates? Really one person, not really one person. This is one guy named Jerome Powell. He's the chairman of the Federal Reserve. But this is just the chairman of the Federal Reserve. He has an entire board of directors of not co-chairs, but folks that help give him advice, help steer our fiscal policy in the United States. And Jerome Powell controls your life more than you might think, even if you didn't know the guy. Jerome Powell and his board at the Federal Reserve determine the federal funds rate, which has impact on the 10-year treasury, which has impact on the 30-year mortgage. You're probably going to know more than most homeowners and home buyers about interest rates over the next 5 minutes as we dive into them. But let's spend 5 minutes talking about mortgages, talking about interest rates, where they've been, where they're going, and the why. So the Federal Reserve, which affects you more than you might think, has only two things they must do. They're called mandates, the dual mandate to be specific. And US Congress created the Federal Reserve with two mandates in mind, and that's all that matters. Number one, keep inflation around 2%. Number two, keep minimal unemployment. Minimum unemployment is thought to be around 4%. So you might be wondering, why do we want 2% inflation? Okay. 2% inflation is needed for a healthy economy because think about this. Let's say we had no inflation. If we had no inflation and I wanted to buy a bicycle, if I could buy a bicycle today for $100, or next week for $100, or next month for $100, or if I could buy it 10 years later for $100, I'm not going to buy it today. I'll wait. I'll buy it in a week. I'll buy it in a year. I'll buy it in 10 years because it's going to cost the same. But if I know that things are going to go up in value, I'll buy them sooner than later. Additionally, think about this. What if we had de-inflation? What if the prices of things went down? A lot of people, especially with the election just happening in November, a lot of people are saying they want the price of things to go down. If the price of things, especially the price of almost everything, started going down, our economy would crash and we would probably slip into a horrible depression and people would die of hunger. Why would we have a market crash, an economic crash if prices went down? Because again, let's use an example. You want to buy a TV, and let's say the TV is $500, and next month it's $450, and the month after that it's $400. The month after that it's $350. You could buy it next year for $200. Why would you buy anything today if it's going to be cheaper next year, and cheaper the year after, and cheaper the year after? This is why Congress wants the Federal Reserve to ensure that we have some inflation. But they don't want it to be too much. They want it to be around 2%. 2%, not too high, not too cold. It's kind of like a Goldilocks number where it keeps the economy moving forward and growing. Also, unemployment rate, they want it around 4%. 4% unemployment is pretty darn close to no unemployment because 4% unemployment really just accounts for the turnover. People moving from job A to job B, people taking a 1-year sabbatical, stuff like that. 4% unemployment is considered about full employment. And we've been around 3.5% to 4% for the last few years. We've had really good unemployment, stayed very low. Now, the Federal Reserve started hiking interest rates about 3 to 4 years ago, and they started hiking these interest rates to slow down the inflation. We'll get into what caused inflation and how you fix it in a minute. But I want to show this analogy, really this correlation between the 10-year treasury and the 30-year mortgage rate. Your 30-year mortgage rate is really based on the 10-year treasury. What's a 10-year treasury? It's an investment. It's like a bond. It's like a 10-year bond that the US Treasury sells on the open market. You can buy one, your mom can buy one, but who's the biggest buyers of these? Usually Wall Street investors. And it just so happens that the biggest buyers of 30-year mortgages are also Wall Street investors. They'll get your mortgage and about a million other, not a million, maybe 1,000 other people's mortgages, bundle them together and sell them on Wall Street as mortgage-backed securities. And mortgages have a little bit more risk than the 10-year treasury, but most mortgages only last about 10 years. Even a 30-year mortgage usually only lasts 10 years. Why is that? Because most people sell their home or refinance it within 10 years. That's why Wall Street draws the correlation between the 10 and the 30 year. And Wall Street usually wants there to be about a 1.5 to 2% spread between the 10-year treasury and the 30-year mortgage. As of late, however, we have seen that spread, the difference, the delta, be closer to 3%. And you can see that gap, how it kind of is about 1.5%, 2018, 2019, 2020. So when we got to around 2022 or so, when rates started going up a lot, that mortgages had more than a 1.5% spread above the 10-year treasury. In fact, if you look, you can see it's about 2.5 to 3% spread. Why is that? It's because any lender giving you a mortgage today knows that the mortgage is not going to last 30 years. It's not going to last 10 years. It's maybe going to last 1, 2, at the most 3 years. Why is that? Because if you get a mortgage today at, say, 6.5%, you're going to refinance that mortgage within the next year or two to like 6 or 5.5 or even 5%. And that investor who lent you the money for your mortgage, they're not going to get 10 years of a return. They're not going to get 30 years of a return. They're going to get a couple of years of a return from you, and then you're going to refinance it and get a new mortgage at a lower interest rate. So these lenders need to make their money now because they're not going to make it over 10 years. And they make it by having a much higher spread between the 30-year mortgage and the 10-year treasury. Now, the lender making the money, it's not your lender at Bank of America or mortgage broker you're working with. The lender is that mortgage-backed security investor on Wall Street. And if this just confused you a little bit, don't worry, but just know that the 10-year treasury goes up means 30-year mortgage goes up. 10-year treasury goes down means 30-year mortgage goes down. So what causes these things to go up and down? And why do we have that spread? Before I dive too deep into it, I want to show you this chart, which really puts that spread on paper. You can see here in 2024, where the 10-year treasury was trading at 4.29, you had 30-year mortgages at 6.96. Almost, not quite, but almost a 3% spread, about 2.75. And usually that's about 1.5. So if the world were normal right now, what is 4.29 plus 1.5? Well, it's about 5.75%. So right now, mortgages should be at about 5.5 to 5.75. But instead, they're at 6.5 to 6.75. As interest rates go down from the Federal Reserve level, as they lower the overnight Fed funds rate, and as 10-year Treasury interest rates go down, you'll see mortgage rates start to slowly go down. But there's going to be one thing that happens that causes mortgage rates to drop like a rock and probably drop 1% in a matter of months. And what is that one thing? It's going to be when the Federal Reserve signals that they're done lowering rates. When is that going to happen? That's probably not going to happen for at least 1 to 2 years. The Federal Reserve is probably going to spend 1 to 2 years slowly but surely lowering rates. Thus, every lender that lends you money knows your loan's only going to last a year or two, and then you're going to be smart and you're going to refinance it to a lower rate. So lenders are going to keep that wider 3% spread between the 10-year Treasury and mortgages. As we get closer and closer to the rate lowering cycle to end, that spread will get tighter and tighter. And eventually, maybe in 2 years or so, when we learn that we're going to stop lowering rates, that's when that spread's going to truncate down again to about 1.5%. And you'll see rates really go down a lot, and you'll refinance again at that time. So knowing all of this, what should you do? And I'm going to talk about this again in a minute, but you should buy now while there's little competition and refinance your mortgage every year or two for the next few years until mortgages get all the way to the bottom. Because as mortgage rates go down, you will see home prices go up. People have complained about not having enough money for this and that. I don't see it in the data. In the data, we see that US personal spending has remained on track since pre-pandemic levels. Spending dropped a lot during the pandemic for about a year, 2 years at the most. And then all of a sudden, in the last year or two, United States citizens are spending more money than they did before the pandemic. So there's a lot of money out there. In San Diego, a lot of times people ask me, Patrick, who's buying $1 million homes? There's a lot of people out there right now with a lot of money, and we see it in the data by just how much US personal spending has not only maintained the trend line, but is above the trend line that we had before the pandemic. And we see why folks are spending. This is US median wage growth. This is where the money's coming from, guys, for all these people buying $1 million plus homes in San Diego and other parts of the country. We saw wages go up in 2021, 2022, and 2023 more than we had in any other 4 year period, at least during my lifetime since I've been looking at this data. And we see not just the highest earners whose wages went up this last year 4.9%, but the lowest earners are getting wage increases 5.5%, 5.4%. So the money is coming. The money is out there. And with all that money out there, we saw inflation. Inflation doesn't just happen. Inflation happens because of reasons. And trust me, it's usually not a president that causes inflation. A lot of folks were complaining about the cost of eggs. And those same folks probably didn't realize eggs went up a lot in price, not because of Biden, not because of politicians. It was because of a bird flu that happened not just in the United States, but around the world. And because of the bird flu, farmers had to kill millions of chickens, and thus your price of eggs go up because there's not as many eggs because of the bird flu. But we have seen inflation come down a lot over the last couple of years. In fact, we're pretty darn close now to that 2% inflation that we as a society, as the economy, want to be at. You can see all items, core inflation right here in October was sitting right at about 2.6, and it was trending down. As I mentioned, October we had a little bump up. That's why you saw interest rates go up a little bit, because we had a little bump up in October, which made folks believe that the Federal Reserve might not be able to lower interest rates as fast as they initially thought they could. Still lower them, but not maybe as fast. Why do we have that little bump up in October? If you want to know why, you got to look back over 12 months and see which one just fell off the radar. October 2023, which was a low inflation reading, 0.1%. And that got replaced by 0.2%. That's why we had that little bump up. Trust me, when we get to around March, April of next year, you're going to see very low inflation levels. And it's not because, again, it's not because of politics or a new president or election. You're going to see low inflation levels February, March, April of next year, because February, March, April of last year are going to fall off the radar. And those were pretty high, 0.4 month over month, 0.4, 0.3. As we get through these January through April months, inflation is going to go down a lot, and you'll start seeing rates come down as we conveniently head into the spring market. So if you wait until the spring market to buy, you're going to face a lot of competition from other buyers taking advantage of low interest rates. Better to buy now and refinance later. If you're a seller, wait until the spring market, because you're going to see interest rates go down, especially as these high inflation readings drop off. The Fed keeps on lowering rates. You'll see more demand for your property when you sell it. Backing up a little bit, let's talk about inflation. What causes it? Inflation today doesn't happen because of what happens today. Inflation takes a long time to really mount and build up, and it takes time to go down. The inflation that we saw in 2021, 2022, and 2023, it was caused by decisions made in 2020. And I don't fault the decision maker in 2020. In 2020, we had a pandemic, and we had two options: go into a depression or dump a lot of money into society so that we don't go into depression. Now, the trade-off of not going into depression because you dump a lot of money into the economy is inflation. And again, I don't want to get political. I just want to be honest. The decisions made in 2020 by the previous administration put a lot of money in the economy through lower taxes, lower interest rates, all times forgivable loans, put a lot of money in the economy. All of that money caused inflation. Remember, there's only two things that cause prices to go up or down: supply and demand. And if you put a lot of money in the economy, demand goes up a lot. And that causes all that inflation that we had. Now, over this last administration, the last 4 years, we saw the tools get implemented to lower inflation. And as mentioned, inflation is going down and it's getting close to that secret level we want, 2%. But what happened over the last 4, 5, 6 years? The pandemic, and then we dropped the federal funds rate, which you can see went down to near zero. We started increasing interest rates, peaked out the federal funds rate, which affects the 10-year treasury, which affects your 30-year mortgage. It peaked out just over 5% about a year ago, and we started lowering rates this year and will continue to in the next year. But inflation was caused by A, these low interest rates that began in 2020, B, lower taxes that put a lot of money in people's pockets, and then these four other things: PPP loans, EIDL loans, unemployment checks being given out. There's just a lot of free money being given away for about a year or two that caused inflation that had to be attacked. So the 10-year treasury went up a lot as the Federal Reserve raised rates. In kind, look at this next chart. This is the 30-year fixed mortgage. And you might think this is the same chart as the one before. No, let me flash again. This is the 10-year treasury. This is a 30-year mortgage. 10-year treasury, 30-year mortgage, both going back over 5 years. So now you're convinced it is the 10-year treasury that the 30-year mortgage follows. It's just usually 1.5 to 3% higher. And as we see the 10-year go down, we'll see that 30-year fixed mortgage go down. But I also want to impress on you that even though rates today are in the sixes, and even though we got up above 7, almost to 8, historically, this is really not that high. If you go back 50 years to the 1970s, you can see mortgage rates used to be around 17, 18%. And you can see it slowly came down over time, bottomed out in 2021 around 2 or 3%. And right now we're kind of where mortgage rates have averaged over the last 50 years. I jokingly say all the time that my goal in life is to never pay off my mortgage. Now, my mom, who was born in 1949, she lived through the 60s, 70s, 80s, and 90s. And my mom thinks I'm foolish to never want to pay off my mortgage. It's because she grew up during a time when mortgages were 10%, 12%, 15%. I and you grow up now during a time, or alive during a time, when mortgages are 3, 4, 5, 6%. And if you can borrow money at 6% or less, my opinion is borrow as much as possible for as long as possible, never pay it off, because you can make a higher return than 6% by buying things like the stock market, by buying things like real estate that traditionally will give you higher return over time. But that's the topic for another day. The main thing I wanted to show you today was the correlation between mortgage rates and the 10-year treasury. The correlation between the 10-year treasury and the Federal Reserve overnight funds rate, and how those are going down slowly, but it will not go down quickly. In mortgage rates, as much as they will go down a little bit every quarter, every year, you won't see a massive drop, like a 1% overnight drop in rates, until the Federal Reserve signals that they're done lowering rates. But as we've kind of alluded to already, you see on the bottom of the slide, when mortgage rates go down, home prices will go up even higher. Even though the median home price in San Diego right now is over $1 million, home prices will keep on getting pushed higher as rates go down. As I mentioned, it'll probably happen slowly but surely. over the next 1 to 3 years. Now, we know by looking at historical trends that buyer demand is heavily based on mortgage rates. And remember, everything, the value of everything based on supply and demand. We already know we don't have enough supply of housing. We just don't. We also know that when rates get below 6.5, buyer demand starts becoming really good. And it gets extremely strong when rates go below 6%. Right now, we're in the mid to high sixes. 12 months from now, we will likely be in the low sixes to the high fives. 12 months from now, buyer demand is going to be teeter-tottering right between the good to the strong. You want to have already bought your house before that happens. You also, again, if you're a seller, the other side, wait until the spring, wait until the summer to sell because you will have much stronger demand as rates get down closer and closer to 6. So where is all this money coming from? Why are values going up? I think we already addressed some of those reasons, but let's talk about some of the macro reasons beyond just the Federal Reserve. Number one, years of pent-up demand from a lack of supply. We also have some of the best, highest paying jobs in Southern California, specifically San Diego. Also, international buyers are making a big comeback into California's West Coast. People simply want to live here because of the good weather, the good job growth. Speaking of job growth, what you're looking at right now is employment growth in Southern California market areas compared to other high in migration metros. If you look across the United States, 7 of the top cities with a lot of job growth are Austin, Houston, Los Angeles, Orange County, Phoenix, Riverside, and San Diego. And as we look at San Diego and as we look at Orange County, our neighbor to the north, we see our job growth really in line with a lot of these other cities in Arizona and in Texas. Now, this is amazing, but what is the issue? Is this next slide. These same cities, the same cities that are experiencing amazing in-migration and job growth are building a lot of homes to house the job growth, to house the folks moving in. Houston, Phoenix, Austin, Riverside, all building a lot of homes. Even Los Angeles building more than us. Which 2 cities or areas are building the least amount of housing? San Diego and Orange County. Least amount of single family permits. And again, we're adding just as many jobs as these other metropolitan areas. We're not even adding a fraction of the housing. That is sure to ensure San Diego home prices continue to increase at a pace faster than the rest of the nation. Don't just take my word for it. John Burns Research and Consulting. You see him in the bottom right there. John Burns Research and Consulting is the foremost #1 research and consulting real estate firm in the United States of America. And they came out with their 2024 report showing that Orange County and San Diego are the strongest real estate markets in the United States right now. Now, if you're looking to buy real estate and you want to lose money, which hopefully none of you do, but if you want to, invest in the states that are slow or very slow. Orange. Value properties can either go down or just stay pretty flat. If you want to buy a safe and secure investment, a home that you can live in and a home that's going to appreciate more than the rest of the nation, you buy in those metropolitan areas that are green or even more preferably dark green. These are where we see the strongest price increases over the last year and likely will continue to in the next year. And not ironically, San Diego and Orange County are the only 2 that are dark green. But it's just not things they pull out of thin air. It's for reasons like this. Not building enough house while having huge levels of population growth due to folks moving in from migration. For this reason, again, it's not just John Burns. USA Today put out an article earlier this year showing that San Diego was one of the top 5 real estate markets in the nation, ranked at #4. Now, USA Today, their economists forecasted San Diego to have 5.4% price appreciation in 2024, this last year that we're about to end. Well, lo and behold, over the last 12 months this year, San Diego homes have actually appreciated 8.7%. much greater than most economists had forecasted. But here's the truth. I've been following economists for years, for at least a decade, because that's when I got my MBA. Took a lot of economics courses and real estate courses. Economists usually undershoot San Diego regarding how much it's going to appreciate. What am I saying? San Diego usually appreciates more than what economists even project. In fact, I've been in real estate now for a decade or so, and there isn't a single year in which San Diego didn't appreciate more than what economists forecasted. So again, last year they forecast 5.4, we appreciated 8.7. This year, a lot of economists are anticipating about 5 to 6%. We're probably going to appreciate again around 8%, maybe even as high as 10 if interest rates go down even further. So what economic growth and expansion are affecting our real estate here in San Diego? Let's take a look at some of the data affecting our home prices, specifically the economy. What's going on in the economy? Well, San Diego's metro became the leader of the pack in venture capital investment during the COVID years, 2020 and 2021. And we see here all these metropolitans on the right. There is no city that had higher growth and gained more VC capital in San Diego, heavily due to our biotech growth in the San Diego region. And that creates no surprise when we see a LinkedIn survey that showed us from 2019 to 2022, over that same 3-year period, and we saw a lot of VC money flowing into San Diego, we also saw the greatest percent growth in tech talent. And what I mean by that is we had more engineers and we had more biotechs move to San Diego than any other city in America on a percent growth basis. San Diego has become not just a tech hub in the United States, it's become a tech and a biotech hub in the world. And you couple that with the amazing weather that we have here, it's no wonder that San Diego home prices have gone up so much. And it's no wonder why, again, John Burns has ranked Southern California #1 in regional rankings for real estate values, real estate prices, and the strength of the market. Anyone who thinks there's a housing crash coming to Southern California has not been paying attention to the real data. If anything, Southern California is going to have home price appreciation for years, if not decades to come, stronger than the rest of the nation. And we see not just the jobs creating that, but also our population growth. Again, anyone who tells you that people are leaving San Diego, stop listening to that person. Because while there are people leaving San Diego, our population is growing through our birth rate and through the people moving here. I always say it doesn't matter how many people move in and out of a city, it matters who moves in and out of a city. If the question is, what's it going to do to home prices? A lot of the folks, as you and I both know, the people leaving Southern California, for the most part, are the folks that can't afford it. The people that can't afford Southern California don't affect home prices anyway, because they're not the ones buying homes. The people moving into Southern California are the ones who can afford it. They have advanced degrees, they have high salaries and incomes, they work in tech and biotech, and they're moving here from New England, they're moving here from Texas. Yes, Texas, anyone who moves out of Texas, the #1 state that Texans move to is California. The #1 state that Californians move to is Texas. So we're doing like a human exchange with them. And the folks that Texas is sending us is some of their wealthiest, highest earning people moving from Texas to San Diego. In fact, San Diego is only one of 50 states, or excuse me, California. California is only one of 50 states. California is only 2% of all states. But 10% of Americans that move to a new state move to California. And while Northern California's population has gone down, Southern California's population continues to grow, including San Diego's population. As you can see, our population has grown 6x over the last 70 years or so. And although we built a lot of housing in the 60s, 70s, and 80s, you can see in the last 10 years, really since the Great Recession, 2007, we just have not built enough housing for the amount of people moving in to San Diego. Our population change is maintained over this last year about 18,000 people. So San Diego's growing by about 18,000 people. Next year, it's projected to be around 18,000 again. I don't think we'll peak over that 20,000 growth. And then we'll start to slow down, but it'll stay positive as San Diego continues to grow. Again, not just from birth, but domestic migration, folks moving from within California and across the country. We can see here the top states, the top cities that people are moving from when they move to San Diego are Los Angeles, San Francisco, San Jose, the Bay Area, Boston, Orange County, and New York City. Are these cheap places to live? Not at all. San Francisco, New York City, LA, these Orange County, these are all very expensive places to live. And the people moving from these major cities see San Diego as cheap. Now, I moved here from North Dakota, so San Diego seemed pretty expensive when I first moved here. But the majority of people moving here are moving from huge metropolitans with big biotech influences, Boston, San Jose, and East Bay Area, all biotech hubs. And they think $1 million home is a discount compared to where they're coming from. So when people leave San Diego, where are they moving to? These other cities: Riverside, Phoenix, Vegas, Nashville, Houston. Folks moving there are the ones who can't afford San Diego. And I hate to say this because it sounds kind of blunt, but the folks moving out of San Diego who can't afford it are being replaced by extremely wealthy, extremely highly paid individuals working in tech and biotech, coming from the cities you see up here in blue. And these people moving into San Diego will ensure home prices in San Diego keep on going up. That's what's happening in our backyard. What you're looking at right now is a study that was commissioned in 2021. The study showed that San Diego County needs to build over 21,000 housing units per year, but we have built less than half of that, just over 9,000 homes on average, the decade leading up to that study. We simply are not building enough. This slide shows you where inventory is still obnoxiously low compared to pre-pandemic, November 2019. So let's look back 5 years. Inventory in all the yellow and the brown states is still below where we were before the pandemic. Now, in the blue states, inventory is actually higher. Between you and me, wink, wink, I would not invest in the blue states because inventory is picking up. And you'll see in a slide here in a minute, these are also some of the states where you're having a lot of natural disasters. In some prices in states like Florida, home prices are actually going down in some areas, but certainly not in San Diego. So nationally, what can we expect for home prices? Well, the average of all forecasts tracked by Resi Club, and they track about a dozen or so different forecasts, the average on a national level is 3.5%. Now remember, San Diego usually appreciates about 2 times faster than the rest of the nation. So we can anticipate San Diego 6-7% appreciation. Based on what I'm looking at in 2025, around 8% plus or minus 2. CoreLogic, again, this is all the US, not just San Diego, 2.4% is their estimate, and Zillow is expecting about 2.9%. US house prices, here's another one at 4%. This is Goldman Sachs. Goldman Sachs is expecting 4%, maybe a little bit higher across the nation. But as you see underlined here, there's 3 areas that have some of the strongest home price growth. And as they know, people assume California would be the worst performing state, but in number 3 is California, especially San Diego. Why is that? Because of what we mentioned earlier. It's hard to build. There's a government restrictions. It's just a challenge to add more housing in California, including San Diego. So anyone that hopes that prices will go down in 2025, unfortunately, they will be disappointed. Prices will keep going up, primarily due to the growing demand and also the lack of supply. Now, lack of supply, like I said, we had too much supply in 2008, 2009, 2010, the Great Recession. But the tables really turned coming out of the Great Recession, and we had a huge undersupply, over 1 million units undersupply on both the for rent in yellow and the for sale that you see here in blue. Along with the lack of supply, We're just not going to see a crash because the loan to value ratio. In other words, the amount of equity people have in their properties. For the first time since I've been looking at data, people have more equity in their properties than a loan. The loan to value ratio for the first time in 2022 went below 50% and has remained there through 2024. And that is especially true in San Diego, where again, we are seeing population growth. Our population go back almost a decade to 2016, where we sat around 3.1 million, where we're at today, just over 3.3 million, and where we projected to go. Well, this shows you going out 10 years, we're projected to have almost 3.7 million, another 400,000 people over the next 10 years. And that represents a growth rate just under 1%, about 0.9%. So you can expect us to add about 30 to 40,000 people per year, year over year for the next 10 years. But we're definitely not adding that amount of housing. So going out 10 years, folks, forget about looking to next year. Let's look out 10 years. If we're adding about 30,000 people a year, 30 to 40,000, but we're only adding about 9,000 housing units a year, and the average home only has about 1.2 people in it, are we going to have enough housing for everyone? Absolutely not. So what's going to happen to the price of existing housing? It's going to go up just as fast as we have seen, if not more. That 9,000 number I mentioned, as you see here, we allowed 9,700 homes to be built in San Diego, which is more than double the 4,700 that we built 2014 to 22, but it's not as much as we need. We need to be building 16,000 plus new homes through 2029, and we are simply not doing that in San Diego. This, and amongst many other reasons, is why homes, owning a house instead of renting it, is a good hedge against inflation. You see in green the rate of home price appreciation, and in blue the inflation rate. In almost every single decade, going back to the 1970s, homes appreciate faster than what inflation does, giving you a good hedge against inflation. If you're a renter, unfortunately, you're getting a double whammy because you're not taking advantage of the appreciation of your house that you could own. And as you see in the green line, rental prices, rents usually go up faster than inflation. So you're really losing money out of both ends if you are renting instead of owning a home. Demographically, just to drive back the point, there's two more United States snapshots I'm going to show you. This shows you where are people moving away from, where are people moving to. So we just did a census a few years ago. We do one every 10 years. Any area that you see in purple or pink, those are counties where the population's going down. I would not recommend buying real estate in those counties because your real estate value is going to stay flat, maybe even go down in value because people are moving away. The counties in green are the counties people are moving into. That's where we've seen population growth. The darker the green, the more the population growth. And it doesn't get any darker than what you see here in San Diego County in that dark green. San Diego County is one of the fastest growing counties in the United States. These green areas are where I would recommend buying real estate and investing in real estate. But now let's look at this other map. Where are expensive weather disasters happening? Up and down the middle of the US. Now, of course, you hear it in Florida now and then, but if you look at in just the last 12 months, 2024, the year we're about to finish, where have the billion-dollar plus weather-related climate disasters happened? It's really up and down this Midwest. It's where I hate to say it, real estate is pretty cheap. Those owners of real estate in these regions are already seeing and will continue to see their insurance premiums skyrocket, making the cost of housing extremely expensive. Now, do we have fires in California? Of course we do, but as long as you don't buy your house at the edge of a canyon or surrounded by the forest, you might not be in a very high fire zone area. A lot of San Diego is not in very high fire zone areas because we're just residential neighborhoods. And as you can see, all the billion-dollar disasters, I don't see any in California here, just up and down the Midwest. And not ironically too, it's a lot of these Midwest areas, look where all the pink is. The Midwest, the Deep South, going up to Illinois, that's where people are moving away. That's where the disasters are happening. So I share this with you just to really show holistically what's going on with human migration throughout the United States. Where are people moving to? Where are they moving from? Why are home prices going down in some areas, going up in other areas? Why are they going up in San Diego? Who's moving to San Diego? Who's moving out of San Diego? Why are interest rates where they're at? And where are they likely to go? Hopefully, we covered a lot of that and more. We've got maybe just like 5 more minutes to close it out. I've been saying for a bit, buy real estate now and refinance it while interest rates go down because you will pay less today than you will tomorrow. You will pay less now than you will next year. You can never change or refinance the purchase price of your property. That's set in stone, but you can always refinance the interest rate to a lower interest rate to make your monthly mortgage lower. And even you've all seen this woman on Shark Tank. She's pretty popular and she's also known for building a real estate empire. And as she says, it's a good time to buy now because the minute interest rates go down, everybody's waiting for them to go down. And even by that point, what they're going to do is rush in and rush back to the market. Once everyone rushes back in the market at the same time, you're going to see prices explode and you'll pay more for the same house. So as she says, you can always refinance when interest rates go down. So what should you do? Wait to buy or buy and then wait? I would say buy and then wait for rates to go down. Because to show you an example of how much home prices could go up, today, at a 7% interest rate, somebody who wants a $4,000 a month payment can buy a $750,000 home. If rates go down just 2.5% to 4.5%, then that same person who can afford a $4,000 mortgage payment, the home's going to be $1 million. So how does this play out? Sellers aren't all of a sudden super nice people and generous, and they say, "Hey, you can have my $750,000 home for $750,000, even though rates went down." People buy homes based on their monthly payment. Sellers sell to these people who buy homes based on their monthly payment. And a person who can afford a $4,000 home today or $4,000 a month mortgage is buying a 750K home. And fast forward 2 years, and let's say rates are 4.5, that same buyer can afford a $4,000 mortgage. That same home that would have cost them 750,000 before is now going to cost them $1 million. You're not getting a better home by waiting for rates to go down. You're buying the same home for more money. That's the way it works in real estate. And that's the way it works with interest rates going up and down, the way sellers react to interest rates going up and down. So what does this reflect? A 2.5% drop in mortgage rates, which I think we could have over the next 2 years. They'll probably go down about 1% over the next 12 months. In the next 2 years, they'll probably 2.5% drop. A 2.5% drop in mortgage rates could theoretically cause real estate values to climb another 33%, a third. And right now, median price in San Diego, 1.05 million. I wouldn't be surprised if 2 to 3 years from now, the median price is about 1.2 to 1.3 million, if not higher. So buy now while real estate prices are relatively low compared to what they could be in the future. And there's a lot of ways that you can buy now and still get a little bit of lower of a mortgage payment through things like a 2-1 buy down program, down payment grants. You can literally get free money to go towards your down payment if you are a home buyer. In fact, this last year, my team worked with a ton of folks using down payment assistance program. And as you see in front of you here, owning beats renting almost all the time. As long as prices go up 3.5% per year, owning beats renting. And nationally, this happens 70% of the time. But that's nationally. Remember, San Diego is different. In San Diego, over the last 10 years, the San Diego average rate of appreciation has been 8% per year. If owning beats renting when home values go up about 3%, then it certainly beats renting when home values are going up on average 8% in a place like San Diego. And I even built an Excel spreadsheet that I share with my clients, and we can share with you if you work with us, and put in your specific price point, your specific down payment. As you see here, 5% down on a $500,000 condo. This was a first-time home buyer with a rate like we see today, 6.5. And if properties don't appreciate at 8%, let's say they just appreciate at 6%. How does a renter versus the owner look in 30 years? Well, The owner versus the renter, the owner pays 3,990 today, and you see that on the far right, and the renter pays 3,000. So a lot of people stop there and they think, well, it's cheaper to rent than it is to own because 3,000 is cheaper than 3,990. But they're failing to look forward 10, 20, 30 years. And over 30 years, as rents keep going up, and even if rents just go up 5% a year, and they could go up even more, the renter pays $2.391 million over 30 years to live in the same property that the owner could have bought for 1.597. That's their payments over 30 years. The owner saves over 800,000. More importantly, though, at year 31, the owner has paid off their mortgage. Now they're just paying taxes, insurance, HOA 2,000. The renter paying $12,000 because 3,000 today going up 5% a year over 30 years is $12,000 a month 30 years from now. And most importantly, the owner now owns an asset, that property, worth over $3 million. A $500,000 property going up in value just 6% a year will be worth over $3 million in 30 years. This is how you become a multimillionaire. You don't need to play the lottery to become a millionaire. All you have to do is go buy a condo in San Diego and sit on it for 20 or 30 years, and it's going to happen. But if you keep renting, I don't have good news for you if you keep on renting. Home ownership remains the number one American dream, even ahead of retirement. And it's really the Gen Z and the millennials that are coming into their 30s and their 20s that want to buy a home. 95.5% Gen Z and millennials want to buy a home. And as I mentioned earlier, these millennials, followed by Gen Z, are the biggest generations we have ever seen. And they're hitting first-time home buyer age, driving up home values. They all want to buy a home for their emotional reasons, lifestyle reasons, but they also see it as a good financial and rational reason for the reasons we just talked through. It's cheaper over the long term to buy a house than it is to own a house. And hopefully you plan on living over the long term. So what are the biggest obstructions to buying a home? A lot of people, 21%, they say they don't know how to get a down payment. They don't know how to get a down payment. 20.8% don't know how to begin. So I'm going to give you a solution to both of these challenges. I'm going to give you the down payment and I'm going to show you where to begin. How am I going to give you the down payment? Well, there's over 20 down payment assistance programs, especially for first-time home buyers. So let's say your first home is a condo, you spend $600,000. If you're a first-time home buyer, I can get you your down payment. This example shows a 3.5% down payment given to you through a California housing assistance program, which ultimately at this price point gives you $21,000 in free money. How can I so confidently say I can give you free money towards your down payment of your first home? Because this last year, 2024, my team helped our clients get over $1 million in access to down payment assistance in just 12 months. So getting you $20,000, $30,000, $40,000 in down payment, something we certainly can help you do. But then the other question is, how do you get started? There's the down payment, but where do you begin? Well, I like this phrase: in order to cross the finish line, you must first cross the starting line. And that's everything in life, including buying a house. So what does the starting line look like in real estate? Well, it looks a lot like this. It looks like meeting with a real estate professional, meet with a real estate agent. The way my team and I work is folks reach out to us every day, every week, and they say, hey, Patrick, hey, Capital Realty, can you help us buy our first house, our second house, our first investment, or our 10th investment? We do all of that and everything in between. And when you reach out to us, what we'll do is schedule a 60-minute meeting where we learn about you. It costs nothing. It costs nothing to meet with us. It's absolutely free. We're not like lawyers that charge you by the hour. Not at all. So you can meet with us for free. I'll be on the meeting with you. One of my team members will be on the meeting. We can do it by Zoom, so you can do it anywhere in the world. And we'll learn more about you for 60 minutes. And then we'll put together a plan to help you and to help guide you to buying your first home. Who you work with matters, though, as the slide in front of us says. Work with someone you trust, work with someone experienced, work with someone who's going to educate you through the process. I like to say my team and I, we don't just sell real estate, we educate our clients, and we educate our clients throughout the entire process. Just as we educated you tonight, We will educate you throughout the process of buying real estate to ensure you know what you're doing with your eyes wide open. And with that said, I'd like to close it out by again inviting you to check out our YouTube channel, where we have a lot of other webinars that dive into different topics, such as how to buy your first home. I got a full 60-minute presentation on the down payment assistant programs. If you've already bought your first house and you want to invest in real estate, I also have numerous presentations that discuss investing as well. And you can find all that and more within our YouTube channel that you can access through the QR code on your screen. Thank you all for joining tonight. Checking out the chat, it looks like there's no questions. But again, if you want to reach out to me for us to help you, or if you just have any questions, feel free to reach me at patrick.capel@compass.com. You can see my email up there in the top right. And with that, I wish you all a happy holiday. I wish you all a very good new year. And I look forward to seeing you all in January, when we'll give another market update as we look forward to 2025. Thank you all and have a good holiday. Bye.